When I logged into work this morning, the markets were in green after 5 straight days of decline, which was a nice surprise to start the day with. But by around 11 a.m., both the Nifty and Sensex had erased those gains and turned negative, marking the 6th consecutive day of market decline. So if you're a worried investor, let's break down what's going on here and make you more informed. Now, inflation, as we know, has been a global problem and India hasn't been spared. The Reserve Bank of India took some strong measures to tackle it by hiking interest rates over the past couple of years to bring inflation under control. And we were making some progress. Indian inflation had been on a declining trend, and this was fueling hopes of a rate cut from the RBI. But here's the catch. Now, retail inflation for October jumped up to 6.21%, hitting a 14-month high. Now, to give you some context, the RBI has a target for inflation at 4%, plus or minus 2%. So with the latest number at 6.2%, we are above that upper tolerance limit. Now, the spike has put a damper on any expectation of rate cut this year, forcing the RBI back to the drawing board to figure out how to get inflation under control. Now, this inflation uptick is one of the key reasons why the market is down. But let's look at what's driving inflation back up, because after all, it impacts all of us. Now, one big factor is food inflation. Now, food prices, which makes up a large chunk of the consumer basket, have surged. In October 2024, food and beverage inflation jumped to 9.69%, up from 8.4% in September, and significantly higher than the 5.3% seen in August. And if you dig a little deeper into food prices, vegetables are the biggest culprit. Inflation in vegetables soared to 42.2%, that's the highest in nearly 5 years, up from 36% in September. Now, while overall inflation is back up, it's worth noting that RBI typically targets what's called core CPI, which excludes volatile items like food and energy. Now, core CPI was at 3.7% according to CARE ratings, more aligned with RBI's target. So to sum it up, food inflation has been a major driver of the overall inflation spike, dampening hopes of a rate cut and adding pressure on the RBI to manage this balance. And that's a big part of why the markets are feeling the pressure. Now let's talk about Donald Trump. Now, Donald Trump is back in the office, and that's set to have a major impact on global markets. Now, we've done a full analysis of how his policies and how they will affect the Indian market, so do check that out. But here's a quick summary. Now, Trump's approach focuses on cutting taxes while raising tariffs on imports to protect American industry. Now, this may sound good for the US economy, but it has some ripple effects. Now, first off, these policies are likely to stoke inflation in the US, which could keep interest rates high for a while. And when US interest rates and bond yields are high, investments in US assets becomes more attractive for foreign investors. Now, this shift in investment can lead to outflows from emerging markets like India. Now, add to that a strong US dollar, something we often see during periods of high US interest rates, and this can also put downward pressure on the Indian rupee. Now, a weaker rupee makes our imports more expensive, especially oil, which in turn can drive up inflation here at home. So Trump's policies aren't just a US issue. They could have some significant costs for the Indian economy as well. Now, another key point to watch is the ongoing selling by foreign portfolio investors. In November alone, FPI sold off a whopping 21,000 crore rupees in Indian equities. And this follows an already heavy selling trend in October, where they offloaded more than 90,000 crore worth of stocks. So why all the selling? Well, there are a few factors at play. First, some investors are cautious about the high valuation in Indian stocks, especially given the recent Q2 earnings slowdown. But it's just not concerns about India. Some of this FPI outflows can also be traced to developments in China. Recently, China has rolled out stimulus measures to jumpstart its economy after the slowdown following the pandemic. Now, these initiatives have been attracting overseas investors who are hopeful that China's economic revival could yield good returns. Now, let's talk about corporate earnings. Now, according to Bloomberg data, more than half of the Nifty 50 companies reported lower than expected net profits for the September quarter. Now, this is a clear sign that corporate earnings are not living up to expectations. In fact, many companies have posted their weakest quarterly performances in over 4 years. Now, in a related development, Jefferies India issued a note where they downgraded fiscal year 25 earnings estimates for nearly 2/3 of the companies they cover. Now, this is the steepest downgrade ratio we've seen since 2020. So when you combine weaker earnings and with already fragile market sentiment, it creates a tough environment for investors. Now, let's talk about what you as an investor should know. Now, in conclusion, the Indian markets are facing a lot of pressure from rising inflation, weaker corporate earnings, FPI selling, and Trump's policies. Now, this volatility may persist in the short term with economic and geopolitical conditions unlikely to stabilize immediately. However, despite the recent fall in the Nifty, it still shows solid 20% returns over the past year, outperforming many other asset classes. So for investors, the key is to focus on companies with strong fundamentals and long-term growth potential. Now, if you're in it for the long term, stick to your strategy and avoid getting swayed by short-term market movements. Also, please remember to diversify. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.